Friday, July 17th, 2020, Maneco 64, home of alternative economics and contrarian views. A lot of mixed signals in the economy. I personally think they don't bode very well, but we're going to look at both. The first one is mortgage delinquency transition. And what is that? Well, I'm going to look at CoreLogic. They're a big corporation that look into the real estate market, into loans, into mortgages. They've just reported that the transition from current mortgages, which are mortgages that are not delinquent, to delinquent or less than 30 days delinquent, that transition has been the fastest since 1999. So this is what they say here: transition rates national. And I'm reading from their website. It says CoreLogic examines all stages of delinquency as well as transition rates that indicate the percent of mortgages moving from one stage of delinquency to the next. The share of mortgages that transition from current. So current means that everything's fine. People are servicing their mortgage. 230 days past due was 3.4 in April 2020, up from 0.7 in April 2019. This marks the highest transition rate since at least January 1999. In January 2007, just before the start of the financial crisis, the current 230-day transition rate was 1.2, while it peaked in November 2008 at 2%. So the other thing I would note is that people who have mortgage forbearance and are not delinquent are not counted in this. This is just people whose mortgages are delinquent. So the other thing I would point out about the real estate market and the current situation, all the plans that have come out, all the help from the government, is that mortgage forbearance does not cover everyone. And according to Wolf Richter here, he's written recently as well about these delinquencies. He says 8.2% of all mortgages in the US, or 4.1 million loans, are currently in forbearance, according to the Mortgage Bankers Association. So there you go. For those people out there who think there won't be a problem in the mortgage market, in real estate, just because there's forbearance, they're mistaken, in my opinion, because it doesn't really cover everyone, the forbearance. Not everyone has taken that help. So there you go. But at the same time, I just saw something this morning in the Wall Street Journal website. It says 30-year mortgage rate reaches lowest level ever, 2.98. And why is this happening? Why are mortgages going down so much? Why are people lending at such low rates, seeing that there's a lot of uncertainty? Well, it's because the Federal Reserve, with all its programs out there to keep interest rates low, to keep treasury yields low, they've pushed investors into riskier bonds, mortgage-backed securities, and as always, central banks, they interfere in the markets. They create malinvestments. And this is what I'm trying to warn you here. Yes, it's good that mortgage rates are the lowest ever, that you can borrow for 30 years at 2.98%. But beware of what's happening on the other side of the real estate market with delinquencies. It's very serious, I would say. The Wall Street Journal says the average rate on a 30-year fixed mortgage fell to its lowest level in almost 50 years of record keeping. It is the third consecutive week and the seventh time this year that rates on America's most popular home loan have hit a fresh low. So yeah, that is a positive, but as CoreLogic says, this is just for April, the data they have for CoreLogic for the mortgage delinquencies. So this is what they say about recession impact on loan performance. In the months leading up to the coronavirus pandemic, U.S. mortgage performance was showing sustained improvement. As of March, the nation's overall delinquency rate had declined for 27 consecutive months, and serious delinquency and foreclosure rates stood at record lows. However, unemployment reached its highest level in more than 80 years in April, reducing affected homeowners' ability to make monthly mortgage payments. And they continue, the CARES Act provided forbearance for borrowers with federally backed mortgage loans who were economically impacted by the pandemic. Borrowers in the forbearance program who have missed the mortgage payments are included in the CoreLogic delinquency statistics, even if the loan servicer has not reported the loan as delinquent to credit repositories. Early stage delinquencies, 30 days to 59 days past due, reached its highest level in at least 21 years in April, with home prices expected to drop 6.6% by May 2021, thus depleting home equity buffers for borrowers. We can expect to see an increase in later stage delinquency and foreclosure rates in the coming months. So that's CoreLogic. That's what they see, not me. But just wanted to point that out to you out there. Yes, there are mixed signals. We have the mortgage rates reaching an all-time low below 3%, the 30-year mortgage rate. But under the surface, things are not really that great, especially with mortgage delinquencies. So with that, we'll move on to see where the markets are this morning. So it's 8:17 a.m. Yeah, Billy is back. Billy, yeah, sometimes I just leave him upstairs if he's like very comfortable. He is getting older. He had his 12th birthday, of course, a few weeks ago in the beginning of July. So where are we this morning in terms of the precious metals? Well, we've got spot gold just under 1800. We're at 1799.66 bid on my system here. The high's been 1801. So we're up just over $2. Yes, precious metals are near this year's highs, of course. They're having a little bit of a fight here. I think they will eventually go a lot higher soon. It's difficult to say exactly when. What about silver? Well, having followed the precious metals market for, almost 20 years, I started following it closely personally in 2002 after I bought my first gold coins. It was not part of my business in the City of London Precious Metals, but on a private basis, I used to follow it. I can tell you that one of the strategies of the bullion banks is that a lot of times, if they're trying to keep precious metals subdued, they will sometimes keep gold subdued, even if silver is doing really well, to try to bring silver back down, and vice versa. So today we've got the silver bashing day, kind of. It's not that bad. Silver is down 10 cents. You'd think silver would be doing a little better, seeing that gold is up. But no, I think they're trying to keep gold and silver here from breaking out. So silver is down 10 cents at 1906. Range has been 1891 to 1924. So that's what's going on there. Of course, I'm not discouraged by the price action. Price action is just something short term. What do I do psychologically? How do I think to stay in this game for such a long time, seeing that it is a frustrating market? Well, you just have to think there's two options really. You can finance the current system and the bankers and the governments by keeping your savings in the national currencies, be wherever they may be, or you can become your own central banker and fight these people and protect yourself versus inflation. Yes, inflation is the debasement of the currency. Have you noticed that your national currencies buy a lot less than they used to 10, 20, or 30 years ago? And that's going to continue happening. So that's what I think about. And of course, you need to be patient. Patience is very important. The Dow future is down 30 points at 26,700. Yesterday, we saw the Dow drop about 135 points, S&P about 11, and the NASDAQ actually underperformed. It was down 0.75% or 76 points. On the year here, the Dow's still down 6.3%, S&P down 0.5%, NASDAQ still up about 16.5%, and the small caps, though, are down 12.2%. So right now, all the major indices, with the exception of the NASDAQ, are down. So this is not a good sign. Usually you want to see the different indices confirming each other. So we'll have to see anyway. S&P future is down 4.5 points at 32.11. The NASDAQ 100 future is down 20 or 0.2%. Currencies are fairly quiet. Sterling is down 4 pips, virtually unchanged at 125.50. The euro is at 113.88, unchanged as well. The dollar is down 0.15 versus the yen at 113.87. And the dollar is unchanged versus the yuan, Chinese yuan, at 699.63. Crude oil was down 0.5%, WTI at 40.67. And to finish off, the 10-year yield, that's at 0.61, so still subdued here. I saw yesterday we got down to 0.60, so that level still support. The 30-year yield, I guess they price off the 30-year mortgage off that, but they also use the 10-year yield. That's at 1.3%. That's unchanged. So there you go. A lot of mixed signals. I don't think things are very clear for the economy. I would err on the side of caution. I think things are going to get more difficult. I don't think we've seen the effects yet, concrete effects of what's happened since the end of March. The data from CoreLogic were for April, so we're going to wait for the next data, which is going to cover May. And that's going to be very interesting. I saw yesterday that President Trump commented that he will only pass another stimulus if he gets, I think, what was it, payroll tax cut. So I think a lot of the support for people, the paycheck support, ends on July 26th. So yeah, we need to keep an eye on this. I would be cautious about the real estate market and the whole economy in general, of course. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, Parlay, and all these other platforms below here. I wish you all a great day. Take care. Bye.